Brad Thomas here with The Street. Here today with Chambers Street Properties Group CEO Jack Cuneo. Jack, good to see you today.
Hey Brad, good to see you again.
Well, it's good to see you at the opening bell today, and we're seeing a lot of new triple net REITs out. A wave of consolidation and growth in this sector. What's driving the triple net sector today?
I think there's a new appreciation, or there's a valid appreciation for income and steady, solid income from good quality tenants. And I think individual investors have been aware of that for years, and I think institutional investors have come to appreciate it. Plus, the performance of the triple net stocks has been absolutely fantastic this year.
Sure, and a lot of people, when we talk about triple net, it's a single tenant property that has contractually long-term leases, taxes, insurance are paid by the tenant generally, but there is management that goes along with being a triple net REIT. You do have a management team, so tell me about your management team.
We feel that that's one of the key things about our company, is the fact that we're very actively involved in the management of the properties and really have good relationships with our tenants. And that's allowed us to expand a number of our tenants. It allows us to work and possibly move them to another location, build a new building for them. So it's that tenant relationship that really creates value. And it allows you to be responsive to them and understand their needs. So you really have to understand their business and really be a partner in their business as they go ahead. Well,
in terms of your tenant mix, you mentioned you've got a very diverse group of tenants in your portfolio. I know Amazon is one of the larger tenants, also still maybe around 6%, 5 or 6%. Mm-hmm. What other tenants are in your portfolio today?
Well, Barclays is our next biggest tenant. We also are, among the other tenants that we have are Kellogg's, Unilever, Raytheon, the federal government, and lots of other really strong, good companies.
Sure. And your business model, you're based globally, so you're in the U.S. I believe you also have a number of assets, maybe around 10% in Europe. Is that correct?
Yeah, we have 5% of the portfolio in the UK and 5% in Germany. And there we have similar tenants, similar type products. What we're seeing is a shift of older, obsolete assets, industrial logistics properties, as they call them in Europe, from an older, they called them sheds, literally, and they were old metal buildings, and they're being built now to what we would consider to be a U.S. standard, a very high ceiling height, cross-docked, lots of truck parking, very well accessed, and so we're following that trend, and we're seeing lots of interesting product come up that way.
Sure. Well, in the single tenant world, you're not buying McDonald's or banks. You're buying larger box facilities.
Right.
And what I find compelling with Chambers Street is your dividend, I believe, is around 5% today. Which is really a nice dividend, especially compared to some of what I call smaller triple net REITs today.
Well, our dividend's 50 cents a share, and we anticipate that that's a good solid number for us. And given our tenants, I think we calculated out that our top 10 tenants, if you take out the federal government, the market cap of those top tenants is over $500 billion. So we think they can pay the rent.
Sure.
So we feel pretty good about it.
So you're finding a lot of opportunities in terms of acquiring new product today. How big is the pipeline?
Pipeline's pretty good. We're projecting about $400 million this year in acquisitions, and we're about halfway through that. And we see a number of really good opportunities coming along. So it's more competitive. It's tougher than it was in 08, 09, and 2010. But we're still seeing some really good assets, so we're happy with the pipeline.
Final 2 sentences on the balance sheet. You've got a very healthy balance sheet, around 30% debt to market cap.
Right.
Tell us a little bit about the balance sheet.
Balance sheet, from the very beginning, we always had the intention of having this be a traded, listed company. And so we always kept a very conservative balance sheet. And we're in the process now of going from a partially secured and unsecured lender. In fact, we did a $700 million credit line, an unsecured credit line, last September, and we had a number of banks that was highly oversubscribed, and so we've been treated, and our rates are the same as those of a traded company. So we felt pretty good about that, and we think that our profile is that of an investment grade company, and that'll be one of the things that we work on next is getting that investment grade rating.
Great. Well, Jack, thanks so much, and congratulations today on the opening bell and the
Thank you.
listing last week, and look forward to following you in the future.
Glad you could join us.
Thank
Thanks.
you. Bye-bye.